Dear students and viewers, I welcome you with another exam style question on the subject of financial accounting. This question will test your knowledge and make you learn the concepts of current and asset test ratios. Zenith School of Accountancy is committed to providing free learning to students from all walks of life. To watch other exam style videos, please explore my channel's playlist. Please also subscribe to my channel to stay informed about new videos. Today's question is: Maverick Ltd has the following current assets and liabilities at its most recent year end. Current assets: inventory $485 million, accounts receivable $190 million, cash at bank $20 million. So the total current assets are $695 million. In current liabilities, the company only has accounts payable of $210 million. When measured against standard acceptable levels for liquidity, the company can be said to have: option A, an ideal asset test ratio but a high current ratio; option B, ideal current and asset test ratios; option C, an ideal current ratio but a low asset test ratio; option D, a high current ratio and a low asset test ratio. Let's first understand the concepts of a current ratio and an asset test ratio. What is a current ratio? The current ratio is a liquidity ratio that measures a company's ability to pay short term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. The formula to calculate current ratio is current assets divided by current liabilities. A good current ratio is between 1.2 to 2, which means that the business has two times more current assets than liabilities to cover its debts. A current ratio that is in line with the industry average, or slightly higher, is generally considered acceptable. A current ratio that is lower than the industry average may indicate a higher risk of distress or default. Similarly, if a company has a very high current ratio compared with its peer group, it indicates that management may not be using its assets efficiently. The current ratio is called current because, unlike some other liquidity ratios, it incorporates all current assets and current liabilities. You also need to remember that the current ratio is sometimes called the working capital ratio. What is an asset test ratio? The asset test ratio compares a company's quick assets, that is, cash and accounts receivable. Quick would imply that it can be quickly converted into cash. Cash itself is cash, and accounts receivable can be converted into cash fairly quickly. So, asset test ratio compares the company's quick assets to its current liabilities. It is one of the six basic calculations used to determine short term liquidity. That is, the ability of a company to pay its bills as they come due. The asset test ratio is considered the most stringent calculation of short term liquidity. The formula for calculating an asset test ratio is quick assets, that is, cash plus accounts receivable, divided by current liabilities. This determines how many dollars a business has available to pay each dollar of bills it owes. Ideally, a business should have an asset test ratio of at least 1 to 1. A company with less than a 1 to 1 asset test ratio will want to create more quick assets. It can do this by offering discounts to increase sales, collecting on accounts receivable, possibly offering special terms for early payment, or asking shareholders to invest more cash in the company. Now let's calculate the current ratio and asset test ratio of Maverick Limited to find out the correct answer. In this case, the current ratio is calculated by dividing current assets of $695 million dollars with current liabilities of $210 million. Dollars. This division gives us a current ratio of 3.321 that implies a high current ratio. The asset trust ratio is calculated by dividing quick assets, that is, cash and account receivables of $210 million dollars with current liabilities of $210 million. Dollars. This division gives us an asset test ratio of 1 to 1. That is an ideal situation. Therefore, based on our calculations, the correct answer is option A. That is an ideal asset test ratio, but a high current ratio in the case of Maverick Limited. If you enjoyed this video, please do subscribe to my channel. Click the bell icon for notifications and also share and like this video. Thank you for watching.